Okay, this is the continuation of 21-1 work together. So the first video completed steps 1 through 2, and now we will complete the rest of the problem. So we are on step 3. It tells us that we're going to journalize the January 1st 20x2 reversing entries for accrued interest income and accrued interest expense on page 15 of the general journal. They already have it labeled for us for reversing entries. I'm going to go ahead and just put in the date right away, January 1st. They do show us our general journal from December 31st, those adjusting entries and those closing entries. What we're going to do here is we're going to be looking at our adjusting entries from before, and we're simply going to reverse those two entries. So I am going to debit interest income for $75, and I'm going to credit interest receivable for $75. Okay, I'm going to do one more transaction. Again, it's on the 1st. This time I'm going to reverse this transaction here. So I'm going to debit interest payable for $60, and I'm going to credit interest expense for $60. Okay, grade step 3. And we can move on then to step 4. In step 4, it says we're going to journalize the payment of cash from the maturity value of the note payable on March 1st, 20x2. We're going to use check number 478. We're going to use page 25 of the cash payments journal. It does tell us a hint. Remember that you do not need to enter C in the check number column of the cash payments journal. Hopefully we know that by now. So they give us some information up here. Here we have our partial unadjusted trial balance, some information on our notes receivable, note payable, and our chart of accounts. We're going to be needing to look at this tab here where it talks about our note receivable and our note payable. So here it says that we're journalizing the payment of cash. So when we're paying cash on our note payable, that tells us that we're going to go into our cash payments journal. So I'm going to start here. They tell us the date is going to be March 1st. That's the maturity date of the note. Okay, now we have to figure out how much we are paying. So we're going to look up here. Here's our note payable. It says that it's a $12,000 note with a 6% interest for 90 days. So I need to figure out what my interest is at. So I'm going to take the principal amount, $12,000, times the interest rate, 6%, times the term, which is 90 over 360. That tells me that my interest is going to be 180. Okay, so I'm going to start then recording my notes payable. I'm going to debit that account for $12,000. That is the principal. So I think I put an extra. Yep. That is the principal amount of the note. Okay, I'm also going to need to debit my interest expense, how much money I paid in expense. So that's the number that I just figured out, which was $180. And then my last is my cash credit. So I'm going to simply add those two together, meaning I paid a total of $12,180. Okay, last step is my source document, which they tell us is check number 478. Okay, I'm going to scroll down. Now it tells me I'm going to journalize the receipt of cash for the maturity value of the note receivable on March 16th to 20x2. Receipt number 278, use page 16 of the cash receipts journal. So now we're saying that we're receiving cash for this note receivable. So I'm going to have to do the same thing. I'm going to have to figure out how much money I'm actually receiving and how much of that would be interest. So I'm going to take the principal amount of the note, $10,000, times the interest rate, 6%, times the term, which is this time 120 over 360. That tells us our interest is going to be $200. So I'm going to go down. We're receiving cash. So I'm in my cash receipts journal. They tell us that the maturity date is March 16th. Okay, I'm receiving cash, so I'm going to debit cash. Okay, now I'm going to receive the principal amount, 10,000, plus the interest, which we figured out to be 200. So that means my cash debit is going to be 10,200. My credit, I'm going to need to credit notes receivable. I'm going to credit for the principal amount of the note, which was 10,000. And then I'm also going to credit my interest income. And that's how much was income, which was 200. Last step then, I'm going to enter in my source document, which is receipt 278. Make sure that my debits equal credits, and I can grade step 4. Moving on to our last step, step 5. It says use the information in question assets to update the T accounts for each journal entry. Enter the date, the type of entry, and the amount. If no entry is required, leave the answer field blank. Record entries in the order in which they were journalized. Okay, so we're going back to T accounts, which you guys haven't seen since beginning of accounting 1. But really they're just putting it out there for us so that we're able to see how these accounts are going to be affected. So we want to look at the description of the entry. This says enter the description of the entry for the following list in the T accounts. Leave the field blank when entries are from cash receipts and cash payments journals. So it says adjusting, closing, or this would be reversing. Okay. And then here they have our journals for us. So here's where we're going to be looking at to get most of our information. Okay, so we're just going to start right up at the top, general journal, page 14. We're going to look at our adjusting entries. So December 31st, it says interest receivable. We have a debit of 75. So I'm going to go down to my interest receivable account. I'm debiting that account for $75. So in this first blank, I'm going to put in the date, December 31st. In the second blank, this is the one that we only fill out if we need to. This is where we're going to put adjusting, closing, or reversing. Now, this is an adjusting entry, so I'm going to put adjusting, and I'm going to just simplify that as ADJ. And then it's a debit of 75. Okay, now I'm going to go back up. I'm looking at interest income now. I have a credit of 75. So going to my interest income, it is December 31st. This is adjusting, and it is a credit of 75. Next one, I have a debit to interest expense. December 31st, an adjustment, and a debit of $60. Next, we have a credit to interest payable. December 31st, an adjustment, and a credit of 60. Okay, so those were the adjusting entries for the 31st. Now we're going to move on to our closing entries on our 31st. We're going to debit interest income. So December 31st still. This time it was a closing entry, so I'm going to write in closing. I'm going to put the full word for this one. And then that was $3,165. Okay, then I have a credit to income summary. So December 31st, closing entry, and a credit of $3,165. Next one, I have a debit to income summary. December 31st, another closing entry, and this time it was a debit of $1,375. And I had a credit for interest income. December 31st, closing entry, and a credit of $1,375. Oops, I put that in the wrong one. Sorry. That was not interest income. That was supposed to go to interest expense. There we go, interest expense. Sorry about that. So December 31st, closing, good thing I caught it, and 1,375. Okay, so we're done with that journal. We're gonna go ahead and notice there's more tabs up here for our different journals. So now I'm gonna go to my general journal reversing entries. So here are my reversing entries. My first one is a debit to interest income. So now I'm gonna go to interest income, and I'm putting in a debit. This date is January 1st, and this is a reversing entry, so I'm going to put REV period. And that was a debit of 75. Okay, then I'm going to credit interest receivable for 75. So January 1st, reversing entry, and a credit of 75. Next one, I'm going to debit interest payable. January 1st, reversing entry, and a debit of 60. And then I'm going to credit interest expense for $60. January 1st, reversing entry, and a credit of 60. Okay, next journal is our cash payments journal. So here I'm going to go first to my notes payable. I have a debit of $12,000 to notes payable. So my date is March 1st. Now in this case, it's not an adjusting, a closing, or a reversing entry, so I'm going to leave that blank and put in my debit of $12,000. Okay, my next debit is to interest expense for $180. March 1st, I leave the second one blank and a debit of $180. And the last one for that transaction is a credit to cash. And they don't show us our cash amount, so we don't have to record that one in a T account. So cash receipts journal. Okay, again, we don't have cash, so we're not going to record that debit. We're going to just record the credits here. So we have a notes receivable March 16th. Nothing in that middle blank, and 10,000. And then we're going to credit interest income for 200. March 16th. Oops. Jeez. And a credit of 200. Okay. So that was all of our journal pages. I'm going to scroll down here. It says use the information and question assets to complete the following tables. It says we're going to list the amount of interest income from this note receivable that will be shown on the income statements for 20X1 and 20X2. Okay, there's a couple things that I want to look at then for this. First of all, I'm going to look at this maturity amount. So